The quickest and smartest way to pay off your real estate mortgages is not any way, shape, or form sending extra principal payments against the mortgage. In this educational episode, I'm going to show you how to pay off your house or other real estate properties about 2.5 years faster, sooner than any form of sending extra principal payments against your mortgage. Get ready. This is going to blow you away. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist for nearly 5 decades, but I have authored 12 books thus far. And my first few books were titled Missed Fortune and Misfortune 101 because of the fortunes people miss out on because they simply don't know what they don't know. So one of the concepts that I taught in my original books, and I continue to practice myself and teach to this day, but a lot of financial jellyfish did not understand it. And so they didn't accomplish what I'm talking about. So make sure you are paying close attention. It's a good goal to want to be out of debt, but you can actually pay off your house 2.5 years faster than any form of sending extra principal payments to the mortgage company, whether it's a biweekly payment plan or whatever. So get ready. I'm going to show you the facts. When we talk about getting out of debt, I oftentimes have to ask people, what is your definition of out of debt? Usually it's, that I don't owe anything to anybody. I don't owe to any mortgage lender on my house. I go, okay. So let me show you how to get there faster than you're getting there the way you're doing it. Because somehow you think that you're getting out of debt quickly by sending all this extra money against your mortgage. And I'll show you that's not the fastest way to do it, okay? It's an okay way. It may be good, but it's not the best way. So there are smart and quick ways. You can send biweekly payments if you understand a biweekly mortgage. What you're doing is a lot of people are paid biweekly. So that's actually 26 paychecks a year. And you send half of your mortgage payment in every 2 weeks, and magically, you've sent in 26 half payments, which equals 13 full payments. It's an extra house payment a year, and you'll pay off your house in 21 or 22 years. And it's magic. There's nothing magic about it, okay? Or just for some form of sending extra principal, or taking out a 15-year mortgage instead of a 30-year mortgage. And in my first book, the very first chapter, clear back in 2000, it said the $25,000 mistake being made by millions of Americans. Well, it's about a $100,000 mistake now, more than 20 years later, because of inflation and what have you. What was I talking about? So many people will take out a 15-year mortgage, tighten their belt, and they want to get their house paid off in 15 years. And I go, well, that's okay, but have you ever taken the differential between that 15-year mortgage payment, let's say of this, and a 30-year mortgage payment, which is less, this differential, plus the tax savings you will achieve the first 15 years of a 30-year mortgage while you're paying interest on a higher balance, and sock that away over here conservatively into a tax-free compounding account. Now, some people say, well, what's tax-free? Well, I'll share that with you. It's called a laser fund. I've been doing it for 4 decades. But interest is your friend, not your foe. I borrow money, let's say at 6% tax deductible interest, a net cost of 4% after the tax deduction, and I earn 8% on that. How much more is 8 than 4? It's 100% more. You accumulate the money over in this pocket, tax-free compounding at a rate twice as much as the net cost of the mortgage, and you'll have enough money in this right-hand pocket to pay off a 30-year mortgage in 12.5 years, 2.5 years faster than sending the extra bigger payment on a 15-year mortgage. And you'll actually do that on a $100,000 mortgage using about $25,000 of Uncle Sam's money instead of your own money. That's why I called it the $25,000 mistake. What that means is if you have $400,000 in a house, or a house worth $400,000, you're kissing goodbye $100,000 down the drain because you're taking 2.5 years longer to get out of debt, and it's costing you an extra $100,000 in the process. You're missing out. I can prove that to you. Let me show you. So those are sometimes smart and quick ways. They're smarter and quicker ways, but the smartest and quickest way to get out of debt is not any way, shape, or form sending extra principal payments against the mortgage. Every time you do that, here, Mr. Mortgage Banker's an extra $1,000 this month. If I need that back, I'll borrow it back on your terms and prove there's a need why I should have it. That's not what we say, but that's technically what you are doing. Okay. So do you know that when my first 2 books were released at the turn of the century, and then Misfortune 101, we went through 500,000 copies of that when it was released in 2005. Well, it got the attention of the Federal Reserve Bank of Chicago, and they had 3 gurus do about a 60-page report about the trade-off between mortgage prepayments and tax-deferred retirement savings, because a lot of people were saying, is this guy Doug Andrew in his book telling the truth? And it took them quite a while to do this, but this was their summary at the after the title page. They said, you know what, Americans, we feel, are making the wrong choice if they're sending extra principal payments against their mortgages. In fact, we consider mortgage overpayments a misallocation of funds. Here's these 3 gurus at the Federal Reserve Bank of Chicago. If you change your allocation of funds by not sending extra principal payments against the mortgage to kill your tax deduction, but put it over here, compounding tax-free at a rate of return greater than the net cost of the mortgage, you can reap a substantial gain. And they were only using tax-deferred accounts, not tax-free ones like I do. And then they said, you know what? This is rather conservative. This isn't cutting edge. This isn't dangerous. This is a rather conservative way of optimizing wealth. Okay? So it was amazing how many people didn't get it. So for years, I've helped people with 3 different concepts. One is equity development. These are for those of you watching this that want to get out of debt, but hopefully you're interested in getting out of debt the smartest and quickest way. So that's good. But I have a little ditty that goes good, better, best. Never let it rest. Never let it rest till good gets better and better gets best. So I also have another module, which is equity management, where I continue to be my own banker. Those are on other episodes. And then ultimately, equity conversion, where there's a lot of Americans that are sort of house rich or real estate rich and cash poor. And you can actually use, let's say, a reverse mortgage. And you can then begin to get tax-free income for life or get rid of a house payment. And you're able to be way better off because houses were made to house families, not to store cash. So let me show you a report that I did years ago. This was because a company had this sophisticated software. You're not going to believe how sophisticated this is. This software would actually have you enter your data and the credit cards and the automobile loans and your mortgages. And the software could figure out which credit card you ought to pay off first, the 12% interest one or the 21% interest one. Yeah, you can see I'm being facetious here. I mean, this isn't rocket science, but people would pay $600, $800, $1,000 for this software that would tell them which credit card to pay off first and which automobile loan they ought to pay off first. That's a no-brainer. So the essence of this was, well, if you want to get out of debt, here's your income and you pay off this credit card first. And then you take those payments and don't go buy another jet ski or snowmobile on credit or even cash. You take that and then you apply it against the next credit card and then the automobile loan and this, and then finally against your mortgage. Okay. And so by getting you out of debt, the average illustration said, if you'll take all of this money that we free up and then you apply it against your mortgage, and we don't consider that, the cost of living is going up in the process, which is a fallacy. But lo and behold, you're going to have your mortgage paid off in 12 and a half years. You're sending extra principal payments against the mortgage, killing your tax deduction. Now the house is paid off in 12 and a half years. And then you sock away that money because we're not going to let you have any more money to live or whatever. And you sock that away into a tax-deferred IRA or 401k in the market, and you'll end up with $987,000. So, that's good. That's good. That's what most people might do. Well, that's not all your money. $987,000 in a tax-deferred IRA or 401k is only going to net you $650,000 after you pay taxes on that. Okay, so that's not really the benefit. So people say, Doug, what would you recommend? Well, at a minimum, okay, if your definition of out of debt is not owing a dime, I can get you there about 2.3 years faster, okay? So instead of sending extra principal payments to the mortgage company, I put it over here in my laser fund in this pocket. A laser fund is a max funded indexed universal life insurance contract where I've averaged 11.17, netting 10.07 cash on cash rates of return for ever since 1980. So I would put it over here in a compounding account. If I'm only earning 9, but my mortgage is 4.5% tax deductible interest, that's a net cost of 3. I'm making 9, I'm only paying 3. I'm making 3 times as much as the mortgage is costing me. Why would I fire an employee that's making me 3 times what they're costing me by getting rid of them, by paying it off, okay? Even if I borrow at 6%, a net cost of 4 after tax, and I'm only earning 8. 8 is twice as much as 4. Why would you fire an employee that's costing you 40 grand if that employee is making you 80,000? That's dumb to get rid of the cost of an employee thinking you're saving money. Is this making sense? So by keeping it over here in a laser fund, it's compounding. And this is very conservative, but that money that they were using would be enough in 10.2 years, 2.3 years faster to where I could take the money out of this right-hand pocket, my laser fund, and pay off the mortgage. And you notice this is an interest-only mortgage. So I kept it simple here. And I can pay off the mortgage 2.3 years faster, usually 2.5 years faster. And it's the same money. But see, I did it because if I give it to the mortgage company, I can't get it back if I get into trouble or get laid off or disabled. I have to borrow it back on their terms and prove there's a need where I should have it. And when you need it the worst, it's the hardest to get. If it's over in a laser fund, I can peel off money anytime I want because it's liquid and safe. So you pay off your mortgage 2.5 years faster. And then you sock away the difference into a laser fund. You'll end up with $1,245,000, and that's tax-free. I use the same rate of return as in the market, and you're only going to net $650. This is twice as much money by doing it this way. And people say, was that what you do? I go, no. What do you do, Doug? Okay, I'll show you, and then I'm going to blow you away. In 10.2 years, when I have enough money in this right-hand pocket, so to speak, that I could, with an electronic funds transfer or phone call, pay off the mortgage, I am out of debt. My definition of out of debt is when I have enough money in this pocket that's liquid and safe, more liquid and safe than in a paid-off property, that it equals and exceeds the mortgage. I am out of debt. My assets are over and above the liability. Does that make sense? By not doing that, I'm not firing the employee, making me 3 times what they're costing me. That's dumb. Why would I do that? That's what happens if you pay it off. I am out of debt under my definition. Now, you don't have to have my definition. I'm just telling you to mine. I'll have $1,800,000. I'll have another $600,000 by not firing the employee that's making me 3 times what they're costing me. But that's not what I do. People say, well, what do you do? This is a one-off. This house that I had a $210,000 mortgage on keeps going up in value. So every 5 years on the average, I refinance it. And I actually, every time I refinance it for a newer, higher mortgage, I get on schedule to pay off the newer, higher mortgage faster than I was on schedule to pay off the older, lower mortgage. Did you hear what I just said? Because every time I separate equity, I'm not going to spend it. I'm not going to consume. I'm going to put it to work at a rate of return double or triple the net cost of the mortgage. I get out of debt faster. This number goes to 4 million, 6 million, 10 million if I repeat the process. That's what thrivers do. They repeat the process. Math does not lie. And so by repeating the process, every 5 years, the mortgage bars go up, but the green bars go up even faster. And this thing goes like this out of sight. And so I end up with $5 and $10 million instead of just doing it once. You repeat the process. What does this all mean? Based upon what most of those people do by sending extra principal payments against the mortgage, they're going to pay about $96,000 of taxes because they killed their tax deduction. The second way, you pay still $83,000 by paying it off in 10.2 years. If I don't pay it off, it's 0. Okay? Which would you rather do? 96, 83, or 0. Good, better, best. How about the difference between what you are paying for the employee and what the employee is making you? So the difference between the 535 and the 118 is 416 the good way, but it's 735,000 of profit the better way. But the best way, and it was just a one-off, it's 1,242,000 here is how much I accumulate. I'm coming out ahead 839 grand by not firing the employee that's making me double to triple what they're costing me. So if you look at the summary, this is good. $500,000 is good if you just put, but $750,000 is better, but 1.2 million is best. I prefer best. Other than that, I don't have any strong feelings on this subject. So if you want to learn more, and if this is intriguing you, I would love to gift you a copy of my most recent best-selling book called The Laser Fund, because you're probably wondering, what is this vehicle that allows Doug to earn 9% compound interest tax-free? And that's why he makes 3 times as much as the 3% net cost of a 4.5% mortgage. Well, it's called a laser fund. What is it? It's a max-funded indexed universal life insurance contract structured correctly and funded properly. And this is where I've earned 11 and netted 10 ever since 1980. You can do this too by diversifying in laser funds and rebalancing. So if you want to learn, I would recommend that you read 2 books, this one and this one, okay? This one is for the left brain learner that has all the charts and graphs and explanations. If you're more of a right brain learner, you learn by stories, you flip it over to this one. This has 62 actual client stories. Now, you can go to Amazon, and these are $20 plus shipping and handling. If you do that, thank you. But I'll gift it to you free. You just simply go to laserfund.com, laserfund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling. Come on, I require some skin in the game, but I'll pay for the book. I'll fire out a hard copy to you. And while you're in there claiming your free copy, if you like to listen and learn or watch and learn, check out the audio and video formats. There's even educational webinars we do on a regular basis. They're free. You can register for one of those. Also, if you want to have a chat with an IUL specialist that I oversee that knows how to do these correctly, you can schedule an appointment, and they'll create illustrations that will show you how a properly structured laser fund may help you in your particular set of circumstances. But if you want to get out of debt the smartest, quickest way, don't send extra principal payments to the mortgage company. Put it over into a liquid safe account compounding at a rate of return, double or triple the net cost of the mortgage, and you'll get out of debt at least 2.5 years faster.